Hello, everyone, and welcome to AI Explorer. I'm Sarah, joined by Michael, and today we're diving deep into a pivotal shift in the AI investment landscape. For the past year, the buzz was all about AI infrastructure, the chips, the foundational models. But now, it seems the smart money is moving up the stack to actual AI applications. Michael, is this shift real, and what's driving it?
Absolutely, Sarah. The shift is undeniable. As foundational models become more accessible, even open-sourced, the competitive advantage is no longer just in building the biggest model. In fact, Goldman Sachs has even noted that open and closed models' performance is rapidly converging. This means that simply having a powerful AI model isn't a guaranteed moat anymore. The real question for investors and businesses now becomes, what does create a lasting competitive edge for AI applications?
That's a critical point. If the underlying AI technology itself isn't a long-term differentiator, then what are the new moats that AI application companies can build to protect their value? What are the key elements that make them indispensable?
That's exactly the right question. There are really three key moats that stand out. The first is deep workflow integration. If an AI application embeds itself into a company's core operations or a user's daily habits, it becomes incredibly sticky. For instance, think of an AI system for law firms that automates document review. If it saves them thousands of hours and slashes costs, they're not going to rip it out. It becomes their standard operating procedure, and that creates very high switching costs.
I see. So it's not about having the fanciest AI, but about solving the biggest headache within an existing process. The more pain it solves, the more irreplaceable it is. What's the second moat?
The second is the data flywheel. This is about proprietary data and continuous learning. If a company has access to unique, high-quality data in a specific domain, its AI will naturally be smarter than a generalist one. And as more users engage with the application, they generate more data and feedback, which in turn makes the AI even smarter, which then attracts even more users. It's a self-reinforcing loop. A new company can't just show up and compete because they don't have that data advantage.
Right, that classic tech flywheel. And the third?
The third is scale and distribution. You can have the best tech in the world, but if no one uses it, it's worthless. A company that can quickly scale its user base, or has a built-in distribution channel like being embedded in a software everyone already uses, has a massive advantage. Someone can copy your tech, but they can't easily steal your millions of users. So, in short, the new moats are this combination of workflow integration, proprietary data, and distribution power. Pure technical novelty just isn't enough anymore.
It sounds like we're moving from a tech race to a utility race, where the AI that solves the most pain points or is most deeply integrated wins. But couldn't a big tech company with vast resources eventually just replicate these integrated solutions or acquire the data? How defensible are these moats against a giant?
That's a fair challenge, but even for a giant, that integration and data have to be earned. You can't just buy your way into a law firm's daily workflow overnight. You have to build trust and prove your value. And specialized data within a niche can still create a defensible space. A giant might be good at general data, but a smaller company could become the king of, say, agricultural drone data. That data flywheel is very hard for anyone, even a giant, to get spinning from a dead start in a new vertical.
That makes sense. So, what we're seeing is that the future of AI value creation isn't just about raw processing power or model size. It's about how intelligently AI is woven into the fabric of specific industries, creating deep utility and leveraging unique assets. This sets the stage perfectly for examining a vertical where this transformation is already in full swing: advertising.
Exactly. And it's a perfect example.
That's a powerful framework. Now, let's zoom in on that specific industry where this AI-driven value reallocation is already making massive waves. Advertising, we're talking about a global industry worth hundreds of billions. Michael, Goldman Sachs estimated a staggering $470 billion in advertising industry profits could be up for grabs due to AI. Can you break down how AI is precisely disrupting these profits and where this money is shifting?
That $470 billion figure is indeed massive, and it highlights just how transformative AI is for this sector. The report breaks it down into four distinct areas where AI is fundamentally changing the ad value chain, essentially reallocating who captures value. It's not just about doing things better, it's about doing fundamentally different things and making existing processes vastly more efficient.
Okay, so let's unpack these four areas. What's the first major disruption point, and what kind of financial impact are we looking at there?
The first, and largest, is channel shift, which accounts for about $170 billion of that opportunity. Essentially, AI makes digital advertising much more effective and measurable. So, marketers are accelerating the move of their budgets away from traditional media like TV and print and pouring it into online platforms where AI can optimize every dollar.
Right, if you can get better results online with AI, why spend money on a billboard? What's the second area?
The second is creative production savings, around $114 billion. Generative AI can now create ad graphics, write copy, and even produce entire video ads at a fraction of the time and cost. Traditionally, creative production could be up to 30% of a campaign's budget. AI slashes that, saving advertisers billions.
Wow. So creative agencies could be in for a tough time. What's the third disruption?
That's agency automation, which is an even bigger piece at about $161 billion. AI-powered platforms are now allowing advertisers to do things themselves that they used to pay agencies for, like media planning, buying, and optimization. Meta has been very explicit that their goal is end-to-end automated advertising with no human hand-holding.
It's like the Mad Men era being replaced by mad algorithms. And the fourth part?
The fourth is the ad tech intermediary squeeze, which is about $25 billion. The digital ad world has a lot of middlemen ad exchanges, various platforms that all take a cut. AI is enabling more direct, one-stop-shop platforms that connect advertisers directly to consumers, cutting out those extra layers and their fees.
So, if AI is essentially making advertising more efficient and consolidating value, it's clear there will be winners and losers. From an advertiser's perspective, this sounds like a dream, better ROI, less hassle. But from the perspective of a traditional creative agency or an ad tech middleman, this sounds like an existential threat. How do you see this playing out for those caught in the middle?
Well, they're definitely facing a challenge. They either have to adapt and integrate AI into their own offerings in a unique way, or they risk becoming marginalized. The value is clearly shifting towards the big platforms that have the best data and the best AI algorithms. They are consolidating the entire value chain.
That's a perfect segue, Michael, because we're not just talking about theoretical shifts, we're seeing it in practice with the biggest players. Google and Meta have rolled out their AI-powered ad products like Performance Max and Advantage Plus. Can you walk us through what these systems do and how they're performing in the market?
Absolutely. These platforms represent the forefront of AI-driven advertising. Google's PMax and Meta's Advantage Plus share a core promise. Advertisers provide basic inputs like their goal and budget, and the system's AI handles everything else, from where to show ads to continuous optimization, and the adoption has been staggeringly rapid. PMax, for example, went from being used by just 2% of Google's US advertisers to 59% in just a couple of years, and it now accounts for nearly half of their US ad spend.
That is an incredible rate of adoption. What about Meta?
It's a similar story. Advantage Plus is seeing rapid growth, with over a third of their advertisers already using it. What's really interesting is that as Meta has leaned into AI, their ad revenue growth has started to catch up to Google's. It suggests that their AI improvements are allowing them to take market share in this new landscape. It's a real arms race.
It's not just the Western giants, is it? What about the Chinese tech titans like ByteDance, Tencent, and Alibaba? Are they also engaged in this AI arms race, and how are they innovating?
Oh, they are all in, and in some cases, pushing the boundaries even further. ByteDance, the parent of TikTok, has a tool that can auto-generate a full video ad in under 5 minutes. They even offer a library of over 3,500 AI-generated virtual spokespeople. A small business can have a digital human actor in their ad without hiring anyone. And they've rolled out their own version of one-click advertising called UB Max, and are so confident in it they've basically forced almost all advertisers to switch to it.
Thousands of virtual actors on demand. That's mind-blowing. And the others?
Tencent is using its AI to generate creative assets for ads within its WeChat ecosystem, and its smart delivery system automatically places ads for advertisers based on a simple description of their product and goal. Alibaba is doing something similar for its e-commerce merchants, using AI to generate countless product photos with virtual models, and then automatically distributing those ads across its platform. They claim it has boosted click-through rates by 45%.
It sounds like whether you're in the US or China, the pattern is clear. AI is driving advertising towards hyper-efficiency, automation, and consolidation. It really is the mad algorithms era. What are some of the broader implications of this trend beyond just the bottom line for these tech giants?
For advertisers, it's mostly great news, better results, less work. For consumers, it could mean more relevant ads. But there are risks. There's the danger of creative homogenization, where all ads start to look the same because they're made with the same AI tools. And of course, there are the more serious concerns about deepfakes, misleading ads, and the privacy implications of hyper-targeting. Regulators will definitely be keeping a close eye on this.
Okay, Michael, this has been an incredibly detailed look at how AI is disrupting advertising. Now, for our listeners who are investors, how do we translate these insights into actionable strategies? How do we capitalize on this AI application revolution?
That's the million-dollar question. For now, the safest bets are undeniably the big platform companies, Google, Meta, and in China, ByteDance, Tencent, and Alibaba. They have the data, the distribution, and they're leveraging AI to capture a larger piece of the pie. But the real opportunity, and where the nuance comes in, is understanding why some AI applications will thrive and others won't.
You mentioned that pure technical novelty isn't enough for AI applications. What then are the characteristics of an AI application that makes it a compelling investment? And how do we identify those gold mines in specific verticals?
The key is to look for verticals that are inherently complex and data-rich, where a specialized AI can create a real, defensible moat. Think about it. A general large language model like ChatGPT is amazing, but it has limitations. It can suffer from what some call dilution of expertise. It knows a little about everything, but isn't a true expert in anything. It can also hallucinate, or make things up. In fields like medical diagnostics or complex legal analysis, that's not acceptable. You need precision.
Interesting. So a smaller, highly trained AI might be more valuable than a giant general one for certain jobs.
Exactly. That's why Bloomberg, for example, built its own finance-specific model, Bloomberg GPT. They knew a generic model wouldn't provide the accuracy and context their financial professional users demand. So as an investor, you're looking for those situations in healthcare, finance, or other complex fields where a company can build a specialized AI that becomes the go-to solution because it's simply better at a very specific, high-value task. That's a real moat.
So it's not just about throwing a general AI at a problem. It's about finding those complex niches where a specialized AI can truly excel. For the average investor who might not be picking individual vertical stocks, what's your advice for approaching this AI application build-up phase?
For most people, I'd suggest a two-pronged approach. First, take the long view. This is a multi-decade transformation, not a get-rich-quick scheme. Second, diversify. Make sure you have core exposure to the established giants that are already winning with AI, the big tech platforms we've discussed. That's your stable base. Then, if you're willing to take on more risk, you can allocate a smaller portion of your portfolio to more focused opportunities, like a thematic ETF for AI and healthcare, or a couple of well-researched, specialized AI companies you really believe in.
That's very sensible advice. It's about being part of the trend without betting the farm on a single horse.
Precisely. It's about participating in this next phase in a measured way. The goal is to find where AI is genuinely forging new revenue streams, not just cutting costs. That's where the transformative value will be created.
Well said. So, to wrap up today, the AI investment landscape is shifting from foundational infrastructure to application layer innovation. Here, sustainable competitive advantages are built on deep workflow integration, proprietary data, and scalable distribution, not just on the AI models themselves.
Right. And the advertising industry is our prime case study, showing how AI is reallocating hundreds of billions in value and consolidating market share among the big tech platforms that wield it best.
And finally, for investors, the strategy involves identifying those complex, data-rich industries like healthcare or finance, where specialized AI can outperform general models, creating truly defensible moats. It's about looking for where AI builds an enduring goldmine.
The AI gold rush is evolving. It's moving beyond just selling the shovels, the infrastructure, to discovering and mining the richest veins of ore, which are the applications. This transition demands a discerning eye, not just for technological glitter, but for the fundamental economic shifts AI enables. The true winners will be those who can harness AI not just to cut costs, but to create entirely new paradigms of value, fundamentally reshaping industries and reallocating wealth. As investors, our challenge is to look beyond the hype, understanding that in this new frontier, specialization, deep integration, and proprietary data are the new currencies of competitive advantage.
All right, that's it for today's episode. Thanks for tuning in, everyone, and thank you, Kevin, for the great discussion. Before we wrap up, let me remind everyone today's discussion reflects personal views only, not investment advice. Please consult professionals before making financial decisions.
That's right. Thanks for tuning in to the AI Explorer podcast. If you enjoyed this deep dive, don't forget to subscribe to our YouTube channel. That's all for today. See you next time.